What's up? This is Wade with Trade ATS, and I want to welcome you to the 7 Insider Secrets of Trading Mastery. So, what this is a presentation that I've put together that compiles a list of the things that I think that if someone is serious about learning to trade, these 7 things are things that I feel cannot be ignored. I'm going to be giving these out as 7 individual lessons, so make sure that you like and subscribe to our channel so you can get notified when each new lesson comes out. All right, so now we're on our second of 7 Insider Secrets of Trading Mastery. So what's the second secret? This one is simple, but it is extremely important. This one we're going to be talking about is trend direction. Understanding market trends is what separates trading from gambling. In my opinion, after working with hundreds of traders in person, thousands of traders through our online programs worldwide, I can tell you right now that when people neglect the direction of the overall trend and trade both directions rather than marrying one side of the market, it usually ends up with bad results for them. Trading in trend is what makes a trader consistently successful in the long run. Trading without a directional bias randomizes your results and makes your process undefinable. So the big question is, how do you master understanding the true direction of trend? Well, there's a number of ways that people do this. Some people will just throw up a moving average and see, are we above the moving average or below the moving average? Sometimes like a 200 period is always common. Some people will just go off of fundamental reasons. They'll just look at what's the overall direction of the economy. They'll look at numbers like GDP, things like that, and make projections fundamentally based off of those factors. There's one way that I've always gravitated towards, and I've taught many people to do this. I think it's really the best way. I'm not going to discount, especially the fundamental analysis. I think you should have that as well. But alongside of that, from a technical standpoint, I really don't think there's anything better than multi-time frame analysis. I've taught multi-time frame analysis to people for literally over 10 years, and it is as true today as it was 10 years ago. I think multi-time frame analysis is the gold standard for projecting where the flow of money is going. So let's look at a quick example. If we look at Euro USD July 2021 through September 2022, it's no secret we've been in a huge down run on the Euro USD. Looking at the left chart, we have a monthly, the middle is a weekly chart, and the right is a daily chart. This is the exact same price action on all 3 time frames, just different time frame. So on the monthly chart, we had 15 months that those candles predominantly moved down. And we're using the Heikin-Ashi to smooth out the candles because I think that it's definitely an advantage to have that smoothing effect when you're looking to simply project where momentum and the flow of money is going. Now on the weekly chart, how many big up moves against the monthly, because the monthly is more powerful, how many big up moves did you have? You had one little move in the middle of that run down that had 4 weeks that were up, which is still not longer than an actual month when you're talking in the terms of actual time. So if you have an up move where the candles were blue in this case only 2 weeks or 1 week, and then you see a yellow right after that, that's showing you there's not a lot of strength in that market. It's all weakness, and it's coming right back in direction with the monthly. So when you see those rotations on your weekly, and then you time that all the way down to the daily chart and even lower on the time frames, the monthly, if you work backwards from that, it keeps you in expectation of where the biggest and the easiest moves are going to be. When people lose sight of this and they start trading both directions, one day they're long, the next day they're short, next day they're long, they're just chasing price around, it randomizes your results as it says up above. It makes your process undefinable. But when you find the most stable time frame to ground yourself in and then work backwards from that, you can see how much this simplifies your process. For 15 months, you literally, if you were disciplined enough, did not have to click the buy button. And you pretty much, as long as you weren't over leveraged and getting blown out of your positions, for 15 months, you potentially could have had not one losing trade as long as you married the monthly direction. That is powerful in itself. And this is one of those things that I think cannot be ignored. If someone is serious about trading and they're really looking for an edge, you have an edge in the simplicity of the candle color, in the candle direction, if you understand how powerful it is and you use it to work backwards to whether you're day trading or you're looking for a few swing trades throughout the week, whatever you're doing, Look at where the monthly's going. Look at the weekly charts. Look where those are projected to go, and then get prepared. Because in this case, all you had to do was be an expert seller of Eurodollar for 15 months. That's powerful.